The FedLife podcast is presented by Serving Those Who Serve, a fiduciary, fee-based financial planning firm serving federal government employees and retirees all over the country. This podcast is for informational purposes only and is not intended to be taken as financial advice. All listeners should consult their personal advisors before taking any action. The opinions expressed by our hosts are their own and do not reflect the views, policies, or position of Raymond James. Securities are offered through Raymond James Financial Services, Inc., member FINRA SIPC. Investment advisory services are offered through Raymond James Financial Services Advisors, Inc. Serving Those Who Serve is not a registered broker-dealer and is independent of Raymond James Financial Services, Inc. And now, here are your hosts. Dan Sipe serves as a branch manager for Raymond James Financial Services and Serving Those Who Serve. Ed Zerndorfer is our guest and federal benefits expert in the space.
Hello and welcome, everybody, to this episode of the FedLife podcast. I am your host, Dan Sipe. Additionally, I'm the branch manager here at Serving Those Who Serve, Lee Sipe & Associates, Raymond James. And I want to begin as I always do by saying thank you. Thank you for taking the time to watch or listen to this. And above all, thank you for your service to the government, to the country, to me, to everybody. You do not hear it enough. You will always hear it here. The other thing you're always going to hear is the guru, Ed Zerndorfer. He's back with us once again as part of that ongoing mission. Say it with me, folks, to reach, teach, and serve you, the career civilian feds. Once again, we are following Ed's FedZone articles. You can find those at fed-zone.com, and I urge you to read them as well. But this gives us one more way to reach and teach. So, Ed, we have a really misunderstood topic today, and that is the Backdoor Roth IRA. So let's jump in with the definition, brother. What's a backdoor Roth?
Yes, Dan, you're so right. We get so many questions about backdoor Roth IRAs. In general, everybody loves Roth. They love Roth. The idea of getting tax-free retirement income is so appealing. We have Roth IRAs, we have Roth TSP. And the question comes up, what is this backdoor Roth IRA? Why can't I come to the front door? What do you mean backdoor? Why can't I come to the front door? Well, let's explain exactly what this backdoor Roth IRA, what we're talking about here. The backdoor Roth IRA is a technique used by high income individuals to contribute to a Roth IRA. Now, you say, why high income? Why can't low income people? Well, here's the issue. One can contribute to an IRA if they have earned income. Earned income means their salary. Federal employees who work, they have earned income. Or they might be retired. They have a spouse who's working. They're eligible, therefore, to contribute to an IRA. There are two different types of IRAs. A traditional IRA and a Roth IRA. Traditional IRAs, in terms of deductibility, deducting contribution, have rules. Roth IRAs also have rules regarding just whether you can contribute to it. Because if your income's too high, in particular, something called your adjusted gross income, your income's too high, you're not allowed to contribute to a Roth IRA. And every year, the IRS lists what those income restrictions are. For example, here in 2024, if one files as married filing jointly, and their adjusted gross income, they and their spouse adjustment was over $250,000, neither the spouse can contribute to a Roth IRA. If you're single, or if you file as head of household, and your adjusted gross income is over $160,000, you're not allowed to contribute to a Roth IRA. You're cut out. You're just not allowed to do it. Not allowed.
Sure.
So, in what way can someone actually get money to a Roth IRA? And it's called a backdoor Roth IRA. It's a way, and it's perfectly legal. This is not a scam. This is perfectly legal to get that money into that Roth IRA. But again, what I said earlier, when you contribute directly to a Roth IRA, you're eligible. You're coming to the front door. You're going to get that money, and there's a house called the Roth IRA. You want to open up the door and put money in there. With the backdoor Roth IRA, you're going to go to the back door and get money in there somehow. And that's what the technique we're talking about here is to get that money through the back door. How do we do that? That's the question. How do you do that? How do you do that? So before we actually get into that, let me just say this again, once again, with the traditional IRA, again, getting back to that, traditional IRAs can be broken down to deductible traditional IRAs in which the contribution you make is going to be result in tax savings. It's an adjustment to one's income. It reduces your adjusted gross income, meaning there are tax savings in the year that you contribute, but everything coming out of that traditional deductible IRA is going to be taxable when you take it out in retirement. And then we have something called the non-deductible traditional IRA. The non-deductible traditional IRA, in which the contributions you make have already been taxed. And then the money goes into the IRA. The contributions accrue earnings depending on how you invest it, interest, dividends. So when you take the money out of the non-deductible traditional IRA, you only have to be taxed on what? The earnings, because the contributions were already taxed.
Gotcha.
Now, what I want to emphasize here is that to make a traditional deductible IRA contribution, once again, your AGI has to be below a certain amount. And It comes down to a simple fact. Are you covered by a qualified retirement plan at work? Now, make it simple. Federal employees are covered by a qualified retirement plan. They're either in CSRS or covered by CSRS, or they're covered by FERS. They're putting money into the TSP. Bingo. They're covered by a retirement plan. So if a federal employee's adjusted gross income is too high, they're not allowed to contribute to a deductible traditional IRA. But a federal employee is always, anybody, no matter what their income is, as long as they have salary, is allowed to contribute to a non-deductible traditional IRA. Now, this is important because in order to do a backdoor Roth IRA, you're going to have to contribute to a non-deductible traditional IRA. That's the important thing.
Yep. So to clarify and kind of put a bow on this, the backdoor Roth is really for the folks that are going to be above the income limits to do that front door thing. So, okay, walk us through how somebody would actually do it.
All right. So, like I said, federal employee has earned income. Mm-hmm. They have a salary. So they are eligible to contribute to a non-deductible IRA.
Gotcha.
So in 2024, because that's that year we're in right now, an individual who has earned income, and that individual is will be under age 50 throughout this year, they can contribute a maximum $7,000 to a non-deductible traditional IRA. If they're 50 or older as of December 31st, 2024, they were born before January 1st, 1975, they can put an extra $1,000 or $8,000 into a non-deductible IRA. And if the person's married, their spouse, whether they have earned income or not, is also allowed to put that same amount into their own non-deductible traditional IRA. Okay? So the money goes in to the individual, and we get the question, where can I open up a IRA? Where do I go? Well, you can go to your credit union, you can go to your bank, you can go to a brokerage. Insurance companies offer IRAs just about any place. But you have to tell the institution you're putting money in, I want to put money into a non-deductible traditional IRA. That's the non-deductible traditional IRA. I mean, gotcha. the bank, the brokerage, whatever, doesn't care. It's going to be deductible or not. You're just going to put it into a traditional IRA. That's what I want to emphasize, as opposed to a Roth IRA.
Okay, gotcha.
So they put the money into the non-deductible traditional IRA, and they get confirmation of their contribution, and they have to make sure that when they file their taxes this year for 2024, next spring, that they file a very important form, Dan. It's IRS Form 8606. Form 8606. Now, why is that form? It's entitled Non-Deductible IRAs. Now, gotcha. Why does that form have to be filed? The reason that Form 8606 has to be filed is, like I said a few moments ago, the institution you go to open an IRA, all they're putting the money into is a traditional IRA. They don't care if it's deductible or not deductible. That's not their issue. You gave them the money and they put it into that traditional IRA. If it's a deductible traditional IRA, Dan, on your taxes, there's an adjustment to one's income. It's called IRA contribution. It's on IRS Form 1040, adjustment to income. So when you list that deductible contribution on Form 1040 as an adjustment to income, that IRS knows that the money you put into that IRA is pre-tax dollars. It's not been taxed. So when you take it out, that contribution, it's going to be taxed because when you put it in with pre-tax dollars, therefore it grew tax deferred, and therefore it's going to be taxed. The earnings and the contributions will be taxed when you withdraw the IRA after age 9.5. But the question is, with a non-deductible IRA, there is no deduction. So how does the IRS know that the money you put into that non-deductible traditional IRA was already taxed using after-tax dollars?
The form.
And that's why there's a form called 8606.
Gotcha.
Now, let me just say this, that before the year 1986, there was no such thing as a non-deductible traditional IRA because all IRAs started in 1974. And anytime you put money into an IRA, back in 1974, when I got started in this business, the contribution, would you believe, was maximum was $1,500. And I will tell you, everyone loved it. You're getting a $1,500 tax deduction. But then in 1986, Congress changed the rules. They said, if you're covered by a qualified retirement plan, any retirement plan, pension plan, and your income's too high, you're not allowed to deduct your contribution. That's when the non-deductible traditional IRA was created. And
gotcha.
Through the years, they've been around since 1986. But here's the problem. Having my tax practice, I get this problem every year. I get retirees who are over 59 and a half, and they're taking money out of their traditional IRAs. And I get a 1099 ARC put in front of me. It showed that the retiree took out $25,000 from their IRA, traditional IRA. It has gross distribution under box 1. What do you think it says in box 2 for taxable distribution, Dan?
Same amount.
Something worse. Unknown.
Okay. Unknown. Oh, that is worse.
Because the brokers didn't know if the money that went in there was deductible or not, but they just put it unknown. Unknown. They didn't know that they had no idea that the individual filed a Form 8606. Therefore, it created a big problem. With the Roth IRA, there's no such problem. There's no forms to file when you file your tax, so you could pick the Roth IRA. But once again, if anybody makes a non-deductible traditional IRA, any contribution in any year, they have to file that Form 8606 to let the IRS know. That's your proof that you already paid tax on the contributions. Now, let's get to the real important part. All right. So, person puts, let's say this year, $7,000 into their non-deductible traditional IRA. They open it up. They file the Form 8606. Shortly after they made that contribution, the $7,000, I'm saying shortly thereafter, like maybe a week or two, they call their bank, they call their broker, their financial planner. I don't know if you've gotten phone calls like this. Dan, I know you're a broker.
Yep, financial advisor. Yep.
Financial advisor. Dan, I want you to convert that non-deductible IRA. I just put $7,000 in there so that I now have a Roth IRA. I want to convert it. Anybody can convert a traditional IRA to a Roth IRA. Anybody. There's no income limitations. Here's the problem. When you convert a traditional IRA to a Roth IRA, you got to pay tax. Tax on what? The accrued earnings. You won't have to pay tax on the contributions. Why not, Dan?
Because it was an after tax.
And how do you know that?
Because
how do you tell the IRS that?
Because you filed the form.
8606, my friend, Form 8606. I love that form. Okay?
Yep.
All right. So, and the reason we're doing it right away is because you don't want to wait too long after you make that contribution to that non-deductible traditional IRA. You don't want to wait too long. You don't want that IRA to build up any earnings, because if you wait long and it builds up earnings, you will have to pay tax on what? The accrued earnings.
Sure.
So you want to do it right away. So you do it, let's say, 2 weeks after you open up the traditional IRA. There's no earnings. You convert the $7,000 you put into non-deductible IRA. What tax do you owe on that conversion? Zero, because there's no earnings. And now it's a Roth IRA. Congratulations. You have a Roth IRA now. You put money into a Roth IRA. That's why
awesome.
It's a backdoor. You go through all this preliminary stuff just to get something that's called a Roth IRA. You're coming to the backdoor.
Gotcha. Now, per your article, you indicate what some of the tax implications of the backdoor Roth are.
Well, the tax implication, we talked about the fact that to make sure that you don't have to pay a tax on the conversion of the contributions you made to non-deductible. Again, that Form 8606. In the article, by the way, it's dated April 18th. Anybody who wants to look at it, I encourage them to do. I talk about that Form 8606. I happen to have it here. And guess what? I produced a Form 8606 in the comments so people can look at it to see if they can see it in the article. Okay. Like I said, if there's a period of time between the time that they opened up, they contributed to that non-deductible IRA, and the time that they converted to a Roth IRA, there's earnings. They want to pay tax on the earnings. And that's one that I would suggest do it as soon as possible. Another thing that individuals have to be aware of, that when you do a backdoor Roth IRA, you do that conversion, the IRS does not allow you to do something called cherry picking. When I say cherry picking, they say, okay, I have this non-deductible IRA, and I'm going to convert that. But if you have other IRAs that you opened up in past years, traditional IRAs, using pre-tax, and you made it with deductible IRA contributions, they built up earnings, you're going to have to take that into account when you do that conversion, the calculation of, as far as the tax implications of the conversion. Any other traditional IRAs you have will have to be taken into account. It's a little complicated, but I will tell you, all this is worked out when you do the calculation of the tax implications of the conversion on what form? 8606. I love that form, Dan.
I know you do. One of the things, folks, you need to be locked down on this stuff or don't try it at home. Get help to do this. So Ed, to kind of round this out, so there's the tax implications. Share with folks what you think the benefits are of the backdoor Roth.
In general, I love Roth IRAs. There are a number of reasons why I love Roth IRAs. Number one, there's no required minimum distributions. No RMDs. When you look around, you see retirement plans like the traditional TSP. Maybe somebody has a 401k plan. Maybe somebody has a 403b plan. All these traditional retirement accounts are subject to RMD. You got to take the money. You got to take the money out. You got to take the money out when you reach a certain age called the required beginning date. Roth IRA, no such thing. Traditional IRA is also subject to RMD. You can keep this RMD indefinitely. It keeps growing and growing and growing. Tax-free compounded growth.
Indeed.
And if you have to take it out, you can. There's no taxes. What happens when you die? Well, if you've
no tax.
Well, there's no
income tax.
Well, you want to maybe you name the beneficiary of your Roth IRA. If it's your spouse can put it into his or her own Roth IRA. How about if you want to give it to your children? Hey, I think this is a great inheritance. Your children will now inherit your Roth IRA. Do they have to take it out? The answer is yes. They can't keep it indefinitely under new rules. They cannot just, keep it indefinitely. They have to take it out. within a certain period of time. It's called an inherited Roth IRA, but it's going to be tax-free. Actually, and specifically, they got to take it out within 10 years of your death, 10 years of your death. But they don't have to take a little bit out. They can wait to the end of the 10th year and take out the whole thing tax-free, Dan. Tax-free.
Gotcha.
Love it, I love it, I love it. Okay.
Yep. And I kind of jumped ahead, Ed, but you also urge people to get knowledgeable counsel for this, correct?
What's that?
You urge people to get knowledgeable counsel on this with a tax professional or knowledgeable advisor, correct?
Yeah, this is not for novice. It's not the novice here in terms of, investing or contributing to IRAs. You need to talk to a financial advisor and have an accountant who is completely on board what you want to do. The keyword is backdoor. This is just not for the average person. If you do your own taxes, let's say you use TurboTaxes in there, and that's a good program, and you're thinking about doing a Roth IRA, you're still going to have to get a knowledgeable accountant to assist you with the mechanics of a Roth IRA, or backdoor Roth IRA.
Gotcha. Well, brother, you did it again. A timely, relevant, and great article where you take something super complicated and you break it down for our feds. So, as always, thank you for being such a great resource. Folks, that's a wrap. We are Serving Those Who Serve, the original, the only. Be sure to hit that subscribe button so you never miss an episode. Share it with friends, strangers, even a few enemies. They'll thank you for it. And do not forget our live webinars every single week. Head over to swserve.com. You'll see the webinar button. Touch it. It changes color. It's fun. Click it, and you'll get the whole menu. We've got 10, 11 of them up there now. So sign up for one, sign up for all. It's the best you can find anywhere because we've got the guru teaching it. He comes to you, reach you where you are, teach you where you are, and above all, serve you where you are. Okay? And be sure to share that page with your friends. Also, be sure to read Ed every single week in the Fed Zone. That's fed-zone.com. You will not be sad. So, to close it out, for Ed, the crew of Serving Those Who Serve, and me, Dan Sipe, good luck, Godspeed, and above all, remember, it's your Fed life. Make it a great one because you deserve it. Stay well, everybody. We are out.